Alright, this is Morgan with TradingPub.com. Appreciate you guys listening to this on-demand video and visiting our site. Real quick before we get started, just give you a second to read through a brief disclaimer. You guys have seen this before, you'll probably see it again. You guys know with trading, you can always make money, you can also lose money when you start talking about futures and options. There's leverage involved, and so with all the stuff that we're going to be talking about today, as well as any of the videos on our site, basically it's just for education purposes only, that we hope can help you with your own trading, but again, it comes down to you having to make a decision on your own. So we'll go ahead and get started real quick. Before we do so, just to tell you a little bit about Trading Pub. The mission of Trading Pub is to provide a place for our patrons where they can hang out with some of the top traders in the industry. The pub is the place to receive quality education, all while interacting with traders and investors who are just like you. So through the Trading Pub, what we want to try to accomplish, obviously we want you to learn. We've got relationships with top traders across the globe that provide education at the cost of free on our webinars, on our site, videos, recordings, etc., content, guest posts, you name it. We provide a lot of free education in the markets, and we want you to enjoy your time at the Trading Pub. You know, we have a very laid-back atmosphere. It's all about learning, and we hope that some of the things that we've done over the past few years have been helpful for your trading. And then also, we want to trade well, but we also want to do good. And so 10% of any revenues generated from TradingPub.com are given to charities. Most of the charities we support have a focus on inner city revitalization and workforce development. But again, I think that's an important part of everyone's trading, to look for opportunities to give back to others. So if you want to stay up to date with us, our website, www.tradingpub.com. For those of you in the Twitter sphere, it's twitter.com/tradingpub, and then on facebook.com/tradingpub. We post a lot of our recordings and event updates on those sites, as well as guest posts. We recently launched a new website, marketdeal.com, which again is basically offering, here's a quick look, offering trading education. Basically it's deals on all types of market related offers, everything at 100% off. So basically at the price of free for you guys, whether it's stocks, futures, options, forex, etc. One of the cool features of the site, there's a trade of the week where we work with professional traders that provide trade opportunities, trade ideas that they're taking, and you can see we post probably about 5 to 10 different trade ideas a week that you can access by going to marketdeal.com and clicking Trade of the Week. Alright, now we'll go ahead and kind of get into the presentation for today. Just to tell you a little bit about myself, I learned about the markets at the age of 16 is when I first started trading. I was by no means a professional trader, but that is really where my trading journey started. I've traded stocks, options, futures, forex, and Nadex, so traded just about everything that you could trade. I primarily trade swing trade futures and futures options, and trade Nadex. So again, those are the primary markets that I trade today. I've had the opportunity to learn from some excellent traders. I would tell you that very few of my ideas are original. They're things that I've learned and picked up along the way, and so part of that is what led to me starting Trading Pub 2 years ago, was just kind of looking at some of the experiences I had and learning from others, and wanting to provide a place and a forum where professional traders could come and share things about the market with other people. So in 2011 I launched TradingPub.com, and in June of this year launched MarketDeal.com as a way to continue to provide free education in the market. So hopefully you guys have enjoyed that. I will tell you, as a lifelong Cubs fan, I've been conditioned for patience and accepting losses. So I think that Cubs fans make great traders because they understand that you can't win every time, and have to persevere through those droughts. So again, just kind of a fun fact for you. But something I want you to think about before we really get going is, think about which one of these two describes your trading. I know that a lot of times I'll look at my account statement at night or at the end of the month and think, man, this really looks like number 2 in that scenario. You're flushing money down the toilet. And there are also times that you look at your account statement and you feel like, wow, I'm just doing great. Things couldn't get any better. And so I hope that you guys are more in the number one boat than the number two boat right there. But again, I think everybody has been there where you're struggling, where you're taking losses, and so hopefully this presentation can help you to avoid some of the bigger losses that you might see, and we'll talk about that. Today's topic is really going to be on defined risk trading and kind of trying to keep your eye on the ball. So we'll talk about a couple of things that cause traders to lose, but real quick, just a quick agenda. What we're going to do, I'm going to start off just sharing a few thoughts on the markets in general, and I'll give you kind of a personal disclaimer of I'm not the smartest person in the world, I'm not the best trader in the world by any means, but I'll tell you how I feel, I'll tell you what I'm looking at, and if I'm right, great. If I'm wrong, it's happened before. And so again, just kind of a disclaimer for you. I think part of trading is understanding that you are not the smartest person in the world, and that you will be wrong, and then figuring out how you deal with that when you're wrong. We'll talk about some swing trading strategies, some reasons why I think swing trading is a good thing for a lot of traders. I think a lot of traders are drawn to, intraday trading or trying to scalp a point here or a point there, and you picture a day trader and it's the guy that's trading hundreds of trades a day, and I think that that's a very difficult way to make a living, and so we'll talk a little bit about that. We'll talk about Nadex, which is one of the markets I trade, and some of the strategies I'll cover today, what it costs, how binary options work. We'll talk about spreads, and then I'm going to cover 3 strategies and show you some past trade examples, just to make sure, not to show you a trade example and say, hey, look how great this was, but show you a trade example and say, here's how the trade technique that I covered works, and try to put it into an example that you can understand. So real quick, and I'll tell you, a lot of this hasn't changed. Some of these things have changed, but a lot of these were thoughts I had at the beginning of the year, and kind of the main theme I had at the start of the year, not so much in January, but really as we got towards February and March, I felt like there would be 2 good shorting opportunities. One, I felt like the overall market, the S&P, would be a good shorting opportunity, and for those of you that have not had your head buried in the sand, you know that that has not been a very good thought for this year. And my second was I felt like the Australian dollar was providing a really good shorting opportunity, and that ended up being a good call, and we'll look at a couple of charts. Another thing I've talked about this year was waiting, and this was really starting around May. I guess March and April, but really in May, talked about again looking for an opportunity to short the Australian dollar against the Japanese yen. If you've watched the yen has just had a historical decline since last year, and I don't think that Japan is really turning it around, but I do think relative to the Australian dollar, it's kind of a safe way to play it. I would rather be short the Australian dollar against the yen than short the US dollar against the yen. As far as gold goes, at this point, I really don't have a good feel on gold. I caught there have been 2 big down moves in gold this year. I caught the first down move in gold, played it very well, and picked up a nice trade, about 40-50 points on that first move. The last down move in gold, I made probably the worst winning trade of my life. I looked at shorting gold when it was around 1370. And was looking at a debit spread on gold, and this is in the gold futures market. Ended up not taking a debit spread. I took a credit spread where I sold the I think it was the 1420 1430 call for $1.90 in gold futures options, and ended up covering it at 40 cents. So I made $150 on that trade per contract. Well, gold dropped over $100. So basically gold had one of the biggest drops it's ever had, and I only made $150 per contract. And I told everybody that I've talked to about that trade, I said that is the absolute worst $150 I ever made. So that was a situation of being right on the market and having poor execution. Whereas the first big down move, I had a debit spread on in gold and was able to pick up a nice move on that, about 40 to 50 points in the futures market. But this last move, really, to have a big move like that and only have a credit spread on, it's just not a good feeling position. So even though that was a winning trade, that's a trade I really felt like I left a lot on the table, and certainly did. As far as oil goes, I think that oil is very hard to trade on a swing basis. If you're going to trade oil, I'd recommend looking at oil stocks as opposed to the futures. I think there's a lot of overnight risk in oil right now with everything going on around the globe. So really staying away from oil except for intraday trades. And then as far as grains go, I think that grains, they've kind of had an interesting move. I think that grains, especially the corn market, is going to be heating up and going to be looking for buying opportunities in corn. All right, real quick, let's look at a couple of charts before we get going. So here's a look at the Australian dollar. And remember I said, kind of starting February, March, I felt like the Australian dollar would be a pretty good trade opportunity. And you see here that I was a little early, that basically Australian dollar rallied some, it rallied up to about 105 and then started to come down. I had a big decline, so that's what I looked for. The only problem with that, in addition to being short the Australian dollar, I also felt like the S&P was short. And so you look at the S&P here, here's a look at the S&P in March. Look at that, you had the one or two down days, thought, hey, we're right, this thing's going to turn around, and then look what happened. So goes to show, just as easily as you can make money in a market like the Australian dollar, where you call a decline and have a great short trade, you can also lose money, and the key is trying to manage your risk to make sure that you don't give back all of your gains with one bad trade. So again, I want to make sure I'm clear. I don't, only want to go over the winning trades, but that was a bad call that I had, being feeling like the S&P was going down. And obviously I'd gotten out well before this point, so I did not catch that down move in the S&P. But I think there's probably more upside to the S&P. The 1700 is going to be a big psychological area. One thing that you'll see, we had a high at 1685.75. If you look at the S&P, we're up here right up against 1674 quarter. The closer we get to 1685.75, you've got a lot of people that are short. They're going to have stops in two places. Number one, they're going to have stops above 1685.75, which is the high of the year. Number two, they're going to have stops against 1700. So as we see the market continue to climb towards those levels, these levels will act like a magnet. Basically, it'll be kind of a run on the stops. So if we come in next week and see the S&P trade 1674, 1675, 1678, the closer and closer we get to 85.75, and then the closer we get to 1700, the more likely we're going to be to break through those and run some stops. Now we'll probably break through those, run some stops, and then correct a little bit. So again, if you're looking to be short the S&P, just keep in mind, pretty much anybody that's short right now, you've got your stops in two places. Number one, 1686 or higher. Number two, 1700. So would not be surprised to see the S&P take out those two levels. So again, keep that in mind. For those of you that are bearish on the market out there, you want to be careful of those two levels as we get closer and closer. And the tendency that people have is they'll say, hey, the high of the year is right here, I'll sell 1683 and just put a 3-point stop in. And what happens, basically, it hits 1683, you go short, and it immediately goes up to 1686 quarter, stops you out, goes up maybe another point, and then comes back down. So that's kind of how we call it the magnet trade, basically, where those key levels start to act as a magnet. I mentioned the corn market, and here's a look at corn. Obviously, corn has not had a banner year, but I feel like it could be kind of getting ready for a run. You see the low on corn around the 490 area, so we're going to keep a close eye on corn. Basically, what we'd want to see is corn break back above that 525 level after it's consolidated. And you see that a lot. You see a big move down, you'll see some follow selling, and then as it starts to consolidate, what I typically look to do is wait for it to consolidate and then start to break out above those levels. So again, be looking at the corn market for some opportunities. As far as the Australian dollar, I still think there's some more downside to go. You kind of had a similar thing. You had the big drop, basically. You had a big rally there. I think you kind of ran. You saw some of the weak shorts get out, and it started to consolidate and come back down again. So look here, there's a lot of support around that 90 level. This is on the Australian dollar futures. As we consolidate and break below that 90 level, again, that'll be a key level to watch and see if we can trade back down to 88, 87 on the Australian dollar. So as far as gold goes, I want to look at gold. As far as gold goes, obviously gold has had a terrible year, and here's the two trades that I was talking about. This was the trade that I actually caught, and again left a lot on the table there, but still I pulled about 40 to 50 points off that through a debit spread that I had on futures options. And this trade right here, right there, you see it, the 1376, 1380. That's the trade where I sold a credit spread. I sold the 1420 call. And the reason I did that, if you look, we had previous resistance at 1420, 1423. So I said, hey, I'll sell the 1420 call. It had about 2 weeks to expiration, sold it for $1.90. And as you can see, gold absolutely fell out of bed. We had from 1386 all the way down to 1180, so almost a $200 move, and I made $150 on the trade. So I consider that a pretty bad trade, even though I was right. And like I said, the worst $150 I made probably in my trading career, and probably will be for the rest of my life. Most disappointing winning trade right there, to call it right and not execute in a proper way. I should have put a debit spread on, obviously, and could have picked up much more of that trade. And the reason I like to trade futures options with gold is just the fact these are some pretty wild swings, and two, what you'll see when you see gold start to get wild like this in the futures market, a lot of times the exchange will raise margins, and so you have a lot of factors at play. And so I like to have defined risk whenever I trade gold, oil, and bonds. So those three markets are markets that I always want to have some type of defined risk trade on, whether it be if I'm selling premium, a credit spread, if I'm buying premium, a debit spread, or just flat out long call, or if I'm long the actual position, want to have some type of option accompanying it. So again, that's important to keep an eye on. Alright, so let's think about this. Why do we lose money in trading? A couple of reasons. Number one, people overtrade, and that's one reason I like swing trading. I think it helps keep you a little more honest when you're looking at a trade that's going to tie up a position and tie up margin for a couple days, possibly a couple weeks. I think that you're going to be more selective as opposed to just kind of jumping in and jumping out. But again, the thing is that you forget that it's actually money. You're actually trading a live account, and you look at that electronic platform, it's so easy to click. Commissions are low, margins are low, and I think a lot of people get in trouble day trading. Another reason we lose money is we're not experienced. I know that I have traded markets before that I was not experienced with. I didn't understand major news events that move those markets. I didn't understand the risk involved, the different types of intervention that governments could cause, and so again, by not being experienced, we can definitely lose money. By putting on too much leverage, we can lose money. And a good example of this is, let's say you're very bearish on or you're very bullish on Apple, and so you look at Apple and you say, hey, Apple's around $400. If Apple were to trade at $350, I think that'd be a great price to buy it. So I'm going to sell a put at $350, and I'll bring in $3 for selling that $350 put. Well, that's $300 per contract. Well, you might be comfortable buying 100 shares of Apple if it gets to $350. And so your mindset might be, if Apple were to drop another 50 points, I'll take Apple long at $350 all day long. Well, that might be fine for you to buy 100 shares. Where greed comes in is you say, hey, I can get $300 for this contract. If I sell 10, I can get $3,000. So if I do that once a month, that's $3,000 a month on Apple, on a no-brainer. And basically I just picked up an extra $36,000 a year. Well, while the trade might work out and Apple would be a great buy even if it dropped to $350, where you get in trouble is something happens and Apple actually does drop to $350. Well, now all of a sudden you're on the hook for 1,000 shares of Apple, of which your account can't hold the position, which means you're over leveraged, which means you have to take a loss, you have to deviate from the plan. The original plan was, hey, I'll take Apple at $350 long. Well, you don't have the money to do so, so you end up taking a loss. That's too much leverage. And so again, you've always got to look at the worst case scenario and try to determine how that fits in with your trading plan. And too much leverage can cause you to have to deviate from that. The number one reason I feel, this is my personal opinion, the number one reason I think people lose money in the market is that losses exceed their gains. And I think a lot of you right now, if you think, if I said, hey, raise your hand if you've had a week where you had 3 or 4 good days, then you had one day that wiped all of them out and more, or you had a good month going on, and towards the end of the month you had one day and wiped out all your gains. And I think probably everybody listening to this would raise their hand and say, that's me. I've done that before. I've had one loss or a string of losses that wiped out weeks or months of gains. And so again, really, I think that's what trading comes down to. I think the people that are able to do this successfully are the people that are able to manage their losses and not let those losing trades wipe out so many winning trades. And the reason that happens is basically part of it's not being disciplined and part of it's being lazy. And it's lazy in the sense that you don't take the time to review your trades and look back and look at the actual numbers. And here's a quick exercise for you to take. Just take a look at your last 10 trades and ask yourself these questions. So look at the last 10 trades. How many winning trades versus losing trades did you have? So look at your winning trades and your losing trades. Then look at the amount of your winning trades versus the amount of your losing trades and do the math. And so here's a quick example. I think a lot of times people focus too much on percentages. They say, hey, I'm right 80% of the time, or 70% of the time, or 60% of the time. Well, it really doesn't matter. You could be right 20% of the time but still make money in the market. What matters is how much do you make when you're right, how much do you make when you're wrong, and then look at the percentages and kind of calculate the numbers. So here's a quick example. Let's say that you are right 8 out of 10 times. So 80% of your trades are winning trades. And I see this a lot in credit trades, meaning premium collection. It's a high probability trade. You sell a credit spread for $1, and you make that dollar 80-90% of the time. The thing that makes a good trader that trades for premium collection is how much they lose when they're wrong. If you have an average gain of $100 but an average loss of $450, after 10 trades you're going to lose $150. And so if you look at that and say, hey, every 10 trades I'll lose $150, you can do the math and just divide your account by $150. You figure out how many trades you have left till you blow up your account. Again, it's a numbers game. And what people tend to do is they have 8 good trades, then they have their losing trade, and they just write it off and say, it's an anomaly. It just happened. It won't happen again. Sure enough, 8 more good trades, 2 bad trades, wipes out all your gains and then some. So again, that's the main reason I've found people lose money, whether you're trading credit spreads, whether you're trading futures, whether you're trading stocks, whether you're trading Forex, whether you're trading Nadex, is that you make very little and then take large losses. Another example, let's say that you're only 40% accurate, but when you're right, you're making $300. When you're wrong, you're losing $150. Well, after 10 trades on that scenario, you're actually up $300. So the person that's right 4 out of 10 times actually can make more money than the person right 8 out of 10 times. And the reason I show you this example is just to try to get you to not think in percentages. Don't say, I'm right 80% of the time. If I were to buy a stock and go for 2 cents profit target and use a $3 stop, I'd probably be right 98% of the time, maybe 99% of the time. But what's going to happen when I'm wrong? I'm going to wipe out almost all of those gains. And so again, you've got to look at your risk and got to look at your reward. And I really challenge you to do this. Look at your last 10 trades. If you don't want to do that, chart your next 10 trades. Write them down as they happen and look at those numbers and see how it works out. Alright, swing trading means that we're looking to hold trades anywhere from a few days to a few weeks. Typically, you're going to risk more on a swing trade than a day trade, but the reward is also greater as well. And so what I would try to encourage you to do is when you look at a swing trade, don't take a trade that doesn't have at least a 1-to-1 risk reward. So basically put yourself in a position where if you're right half the time, you're at least breaking even, if not making money. If you're in a situation where you've got to be right 70% of the time to make money, where maybe you're risking $300, but you're only making $200 or you're only making $150, you've got to be right a very high percentage of the time just to break even. So again, look at least a 1-to-1 risk reward, if not better, or maybe you're risking $1 to make $1.50. And with swing trading, I feel like that's a definite possibility to catch some of these trending markets. And also look at option strategies to help with overnight risk. The one thing you've got to do, and it's always good to use a stop, but a stop will not protect you from overnight risk or from gap risk. So look at option strategies to do that. There's several different things you can do. We don't really have time to cover it on this webinar, but if you would like, I'll be happy to send you an options presentation. You can email us, support@tradingpub.com. We've got a lot of good information there that we'll share with you. If you go to tradingpub.com or Market Deal and look under the options section to try to help teach you about these strategies to help hedge your portfolio. And again, one thing that you've got to do if you're trading, and some people will tell you they don't do this. I feel like it's a good thing to do, but set a target. You know, you're not always going to catch the move that goes to infinity. You're not always going to short the stock that goes to zero or short the market that goes to zero. At some point, markets turn. And unless you're looking at a Bear Stearns or Lehman Brothers, obviously they did pretty much go to zero. But again, those are rare occurrences. So again, look for opportunities. When you're right, take it off the table and be done with the trade and move on. So I think a lot of times another reason people lose money is they'll sell something, it drops a lot, and they say, okay, I'll put my stop at break even. Then what happens? The market retraces and stops you out, and basically you were right on the trade, but you didn't make any money. And so again, you know, put your profit target in, take your profit target when it happens, just like you'll take a stop out when it hits your stop. All right, I'm going to talk a little bit about Nadex, and Nadex is an exchange. The thing that's cool about Nadex is it's an exchange that's actually built for active individual traders. So it's not geared towards the high frequency firm, it's not geared towards hedge funds, it's geared towards individual traders like myself, like many of you listening to this conversation through the on-demand recording. It's the North American Derivatives Exchange. The good thing about Nadex is it's actually CFTC registered. That means they're a registered exchange that is has to report and basically has oversight by the CFTC. When you look at binary options, you'll see a lot of firms, if you do a Google search for it, a lot of offshore firms. Not to say that every offshore firm is bad, but I will tell you this, that if you're sending your money somewhere, somebody's holding your money, two things you want to know is, number one, does this firm have a financial interest against me making money? And you have that with a lot of the offshore firms. They're dealing firms, meaning they're taking the other side of your trades, kind of like a casino. If you think about it, where the house always wins, and they've done the math, these firms wouldn't be operating if the house didn't win. So again, the thing with Nadex, they are an exchange, which means they're not trading against you. You're trading against other traders or market makers, but you are not trading against the exchange. Nadex exchange just facilitates the trade, just like any other exchange. The other thing is that they are regulated. They're U.S. based, and so whenever I'm putting my money in an account, I want to know who's looking after this person or this exchange, and I know that Nadex is regulated, and that's one thing we like about them. In addition to the fact that their contracts are designed for active individual traders, there's a low cost of entry, limited risk on every trade, it's defined risk, and they're fully collateralized contracts. It's the only U.S. exchange that accepts direct retail members. So basically, by opening an account, you become a member of the exchange. There's no membership fee. You can deposit as little as $100 to get started. And we actually have a agreement set up with Nadex with anybody that goes to Nadex through the trading pub. Once you open a live account, you can get set up with a demo for a full year to practice. You just email dan.cook@nadex.com. If you send an email to dan.cook@nadex.com, just tell him you heard about Nadex through the trading pub and you want a 12-month demo to practice. He'll give you a demo that's good for 12 months so you can practice. The way that Nadex charges, there's no commission on the trades, it's just an exchange fee. So they charge 90 cents per lot per side. So again, to buy a Nadex contract, it's 90 cents exchange fee. To sell a Nadex contract, it's 90 cents exchange fee. Now, on their contracts, if they're expiring and it's a losing trade, they won't charge you the expiration trade on the way out. So if you buy a Nadex contract that's going to expire worthless, you don't get charged on the losing side of that trade if it expires worthless. So the cool thing about it, though, is that they've got it priced pretty low for when you're first starting. So if you're just trading a one lot, in and out, you're looking at $1.80 for the round turn. But once you start trading more contracts, the fees are capped at $9. So if you trade a 10 lot, it's going to be $9 to get in. If you trade a 20 lot, it's going to be $9 to get in. If you trade a 30 lot, 40 lot, 50 lot, 100 lot, you're looking at $9 to get in, $9 to get out. So the fees are capped at $9 per order. So what I recommend is opening an account, trading the demo account, getting used to it, start out trading, one contract, in the live account. And as you continue to progress, some of those economies of scale can really come in handy when you start looking at how much commission you would generate if you were being charged, in most markets on a per contract basis, whereas Nadex caps at $9 a trade. Alright, so binary options, we'll talk about that, and then I'm going to go over some strategies. A binary option is a simple short-term contract. They have intraday, daily, and weekly contracts. Every trade has limited risk. So again, when you get into the trade, and we'll show you some examples later, but you see exactly what the max is you can make and what the max is that you can lose. So they have a max gain and max loss. Now you can trade in and out of that. So let's say that you buy something that has a max profit of 40 bucks. Well, if you get out early, you might only make 30 bucks on the trade. Or if you see something that has a max loss of $30, if you get out early, you might only lose 15 versus taking the full $30 loss. Basically, a binary contract is a yes or no proposition. It's very straightforward. So for instance, let's say that there's a binary for the end of this week for the S&P to close above 1700. Well, if the S&P closes above 1700 at the end of the week, then that contract will expire at 100, meaning it's a yes. It closed above 1700. If the S&P closes below 1700, then the answer to that question is going to be no, so the contract will expire at 0. Now, all throughout the week, we can trade that contract up and down. We could be long, we can be short. As we get higher, the contract goes up. As we get lower, the contract goes down. But at expiration, there will be a cash settlement. And that's one of the things people get confused about with Nadex. You don't have to stay in the trade through the end of the week. You can get in and out. And again, it's priced for the retail trader. Each contract basically is $1 per tick. Here's a couple of the rules I use for binary options. Going back to the thing I shared at the beginning of the session. Number one, I'm not the smartest person in the world. That's step one. Realize that. Realize you can be wrong and look for things you might be missing. Step two, I try to determine the overall market direction. Step three, when I'm bullish, I look for a binary around $60 to $80 in price. If I'm bearish, I look to sell at $25 to $40. So again, if you think about the binary trades from 0 to 100. So again, it trades from 0 to 100. If we're trading right at the strike price, it's going to be trading at 50 because basically it's a 50-50 probability when we're trading right at the strike price. As we trade above the strike price, the binary option continues to go higher, kind of like an option in the money. As we trade below the strike price, the binary option starts to go lower. So basically what I try to do, if I'm bullish something, I'll look to buy around 60 to 80 in price, giving myself a little bit of an edge. I want to put myself in a situation where if I'm right, I make money, where if I'm only wrong by a little bit, I can still make money. In order for me to lose money, I've got to really be wrong on that trade. And then if I do so, it gives me time to get out without taking a full loss. If I'm very bullish, I might look for a binary around 30 to 40 in price. If I'm very bearish, I might look to sell something at 60 to 70. So if I have a really strong feel about the market, I might give up that edge in order to have more reward. But typically, I would rather limit my reward a little bit, but increase my probability, and then still use the 50 level on the binary to manage my risk. So, for instance, let's say we pull up the S&P again, and here's a chart of the S&P. Let's see, here's a chart of gold. Okay, we'll take gold as an example. Let's say that I feel like gold is going to go down next week. Okay, so I think gold's going to drop next week. Well, I could look at a Nadex binary and I could say, okay, we're at 1283. I might look at the 1290 binary and say I'll short that, saying that we won't get above 1290. So basically what I've done is I've given myself about $7 of buffer there to be right on the trade, or to be right on the trade. If that binary if gold starts to trade above 1290, I'll look to exit the trade. I won't wait for it to go to 1350 and say, hey, I'm dead wrong, I'm going to take a full loss. You've got to be able to manage your losses on the trade. If I thought gold was going to go up over the week, we're trading at 1283, I might look to buy either the 1280 or 1275 Nadex binary, which I'd have to pay up a little bit. But again, I'd rather have that buffer to know, hey, if gold comes back a little bit, I can still make money on this trade. So again, when we look at the examples, I think this will be make a little bit more sense for you guys. Alright, so here's an example of a binary option, and this is just a screenshot I had taken from a while back to show you. I've got a good side-by-side here. So This is an example. You see US 500, which basically translates to S&P 500, and just think about these prices as an example. If you're looking at this above 1453, okay, so the price at the time of the S&P is probably around 1455, 1456. Basically, what we're looking at here is for the S&P to be above 1453 by expiration. Notice that this binary options trading at 74. Okay, 74 right there. Basically, you've got an edge that tells you that the market's trading above the strike price because it's above 50. If we were trading right at 1453, you would see this market right at 50. Now, the way that binary options move is that as the market moves around the strike, you'll see the binary move. So when you see it below this 50 line, that tells you that the underlying was below. When you see it above, that tells you the underlying's above. But you see there's really some good opportunities to trade this for those of you that are intraday traders. You see some pretty good moves from 40 to 70 to 40 to 70 down to about 55 up to 85 down to 70. So there's some really good moves and good ranges trading these markets as it starts to get around the money. So again, that's just a quick example of how it works. All right, now here's an example. This is an example of a low probability trade but high reward. All right, a low probability trade and high reward. Here's a look where you have a market at 1791 and a binary that's telling you to make money on this trade it's got to be above 1794. So basically for this trade to make money, it's got to rally at least 3 or 4 points before you can make any money. So basically what you see here is that to buy this contract it's trading at 35. And here's how the Nadex platform works. It shows you your max profit and max loss. If you buy at 35 and the most you can make is 100, then basically that tells you your max profit is $65. If you buy at 35, the lowest it can go is 0. That tells you the most you can lose is $35. So again, here's an example where you're buying this trade, you feel like this market's going to go back above 1794. And again, we're just using these numbers for examples to try to explain the trade opportunities. But again, this is a lower probability trade because let's say that you're right and this market goes up to 1793. Well, it's not enough, so you still lose money. So in order to take the lower probability trade, you've got to look for a higher reward, but your risk is still set at $35. The most you can lose is $35. The thing I like about this is, let's say that all of a sudden the market drops 15 points. All right, well normally if you're just trading the outright, you're going to be stopped out. How many of you have had a situation where you're long a market, it went to your stop, stopped you out, and then it turned out being a great trade? Well, by having defined risk trades on, just because the market goes against you doesn't mean you're stopped out of the trade. It just means that you know getting into this is how much I can lose on the trade. Now here's the flip side. This is a high probability, low reward trade. So looking at this here, you see the market. This is saying that you're betting that the market will be above 1784. All right, so above 1784. You see this market at 1791. All right, so basically there's 7 points in the money there. Now you can buy this market at say $89, and basically the highest it can go is 100, so the most you make is $11. The most you can lose is $89. You might look at that and say, hey, that's a terrible risk and reward, right? Well, the key to this type of trade is, one, it's high probability, so you're going to make money more times than you lose money. The key is managing against it when you're wrong. What you cannot do is allow this trade to go all the way down and lose $89. So this is where I use that rule. If we see this trade go to 50, I'll look to get out of the trade. So basically what I've done is said, hey, my max loss, if we have a flash crash, if things just get really bad and I can't do anything, my max loss is $89. However, I'm going to manage this trade and try to cut that at $50. Basically, if we trade to 1784, that means I'm wrong. As long as this market didn't drop 7 points over the next hour, then I would make money on the trade. Now you look at that and you say, hey, that's still not a great risk reward. Well, here's the way that credit trades work. Is you look at it and you say, okay, on this credit trade I've got a high probability trade to make $11. My risk is $89. So basically you're pulling in about a 12.35% return. So about a 12% return on your money in a short period of time. Now the reason you're making this is you've got the risk. You're taking the risk of a full loss at $89 per contract. But again, if you're looking at a market, you think the market's going up, you think there's a lot of good support, you can use that situation. This is a premium collection technique, basically where you look to buy an option on Nadex, a binary option that's well in the money. Look to buy it around that $80 to $90 area, and you're able to bring in a pretty good return on your money. Now the key is managing the risk and not taking that full loss and using that 50 level. So if this market traded to 1785, 1784, have to cut the trade and just say you're wrong and come back another day. Alright, now I want to talk a little bit about bull spreads before we wrap things up. This is another contract. There's some really cool things that you can do with these contracts when pairing them with futures or forex contracts as well. But basically it's a simple short-term contract, daily and intraday. All the trades have limited risk, fully collateralized. It's very similar to a vertical call option, basically looking at a call spread. And basically what this allows you to do is trade a market with a range, with a floor and a ceiling. It can be traded long or short, and again each contract is $1 per tick. And here's a couple of the rules with spread trading. With more volatile markets, I try to buy near the floor or sell near the ceiling to minimize risk. For less volatile markets, there's some opportunities to collect premium to take advantage of that by buying a bit closer to the ceiling or selling a bit closer to the floor, and I'll show you examples of both of these. Alright, so here's an example looking at gold, and as we talked about with gold futures, you know, when they start to get volatile, the exchanges can raise margins to trade these things. Some brokers will charge 10, 15,000 in margin just to trade one gold contract. Here's a look on the Nadex platform. Basically, you see here, let's say you're looking at the gold market and you want to short gold. Alright, and it's at 1791, 14, you can change the number, 1491, 1391, 1291, 1191. But again, just for example's sake, here's a side by side. So gold's at 1791. Let's say you short the futures market and it rallies up to 1805 and you get stopped out, and then it might come back down and you say, well, you know, I was right on gold, but it went up enough to stop me out. Here's the cool thing with Nadex. They have spreads where you trade a range. You see this range at 1750 to 1800. That means the most you can lose is at 1800. Now if it trades to 1805, then basically your trade's at max loss. If it comes back down before expiration, you're still in that trade. So you're not out when it hits that point. You're out at expiration. So basically, this is an example if you sold 5 of the Nadex contracts at 1790.2. So you're giving up about a point here in order to take risk off the table. But again, look at this. Your max loss on that trade would be $490. You're able to stay short gold pretty much until expiration at 130 right there, with a total risk of $490, a total profit of $2,000 if it were to drop to 1750. So again, what it allows you to do is put a position on in a volatile market like gold or like oil that's really moving a lot, or when, you know, certain currencies are moving a lot, or there's big news coming out in the grains. You know, if you're trading oil and there's a 9:30 Wednesday API announcement with the oil inventories, or sorry, with the EAI, not API, with EAI, and with the inventory announcement, you can put these trades on near the floor, near the ceiling, and have a low risk, high reward situation. So again, the 3 strategies, one is credit strategies on daily binary contracts, number 2 is spread strategies, and number 3 is spread strategies with small edges, and I'll show you an example of each real quick. Here's an example of a credit strategy, and if you look at this market over here, notice that there's resistance at 93.47, basically support around the 91.20. Here's an option saying that if crude is over at 93.50, crude has to be over 93.50 for this option to pay out at 100. So this is a credit trade, basically selling a crude option at $10 that it'll stay below that 93.50. So the way that this trade was determined is say, hey, we've got resistance around the 93.20 area, so I'm going to go up a little bit, give myself some room, and say I'll make money as long as it's below 93.20. I've got some good support at 92, and so actually you can put this on as a condor. So what we've done here is we're buying the binary saying that crude will be above 92. We're selling the binary saying that crude will be below 93.50. So basically what we've done here is as long as crude's between 92 and 93.50, we make $10 on this trade, we make $19 on this trade. So here's an example where we make $29, and by using our risk reward, we say, hey, if this thing trades to the strike price, it'll be at 50 and I'll get out. Well, if we trade to 93.50, this option's at 50, we get out, we lose 40 bucks. We still make the 19 there, so we only take a $20 loss on that trade, and we have a very high probability of success with this trade. Here's an example of the settlement of the 92 long. Basically, the way this works, remember this option expired at 2:30. The thing with Nadex is literally about a few seconds after the trade, the money's in your account. So it says your position in the crude market was above 92. It's settled, the payout was 100. So if we bought it at 81, the payout's 100. That's a $19 profit. All right, trade example 2. This is another credit strategy. Just looking at it, basically what you're seeing here is you've got a market that had some support or some resistance at 15.20. We said, hey, let's go up a little bit, 15.25. You sell it at 12 bucks, and basically at expiration, as long as it stays below 15.25, you make money on the trade. So again, there's the resistance on that trade. Now the key thing, like I said, managing the risk and not taking a full loss. So here's a look at the trades when they're in an open position. You see there's the crude oil being above 92. There's another one that you're short below 93.50, and then another contract that you're hoping the market stays below 15.25. Now here's an example of the binary option movement. One of the on the S&P trade that day, the S&P actually rallied, but notice it didn't quite get to the 50 point. So this is where we sold it. It came very close to getting to that 50 point. Our resistance level held, and it came back down, and it ended up being a full profit. But again, had this gone back above 50, that would have been a losing trade. But again, it shows you there's some really good trading opportunities inside these options as it starts to move. Now here's an example in the spread market. We're going to try to wrap up in the next couple of minutes. But here's an example of the spread market, basically looking to buy near the bottom of the spread or sell near the top. So you see here that this market's at 15.1920, and you see a spread at 15.20 to 15.50. So basically this allows you to buy the S&P. You see 5 contracts on Nadex equals 1 contract on futures. Imagine being long an S&P futures contract. You can be long for the entire day. You've got a max loss of $45. So that would be the same way of saying, hey, I'm going to buy the S&P here at 15.20, 15.20.50. The most I can lose is $45, and whether we go to 15.10, 1500, regardless of how much it drops, the most you can lose is $45. And the most you could make is if it rallies to 15.50. So again, that's an example of trying to buy near the bottom of the spread or sell near the top. So when you're in a situation, if you're bearish on the market right now and you feel like this thing's going to turn at any second, if you're shorting the S&P futures right now, you're really struggling, having a tough time. You can come into Nadex, put on a defined risk trade where you say, hey, I'll take a small risk for a potential big reward if this market drops. Or if you feel like the market's going to rally 20 points, you can come in, find a spread, try to buy near the floor, have a very low risk and a higher reward on the trade. Now if you're in a market that you feel is more steady, there's opportunities for premium collection. So this would be selling near the floor or buying near the ceiling. You might say, well, why would you do that? Well, if you feel like the market's not going to move much, you can kind of pick up a spread. So basically what you see here, here's a spread at 14.80 to 15.20. Now all of the Nadex contracts at cash settlement, they have cash settlement against the underlying. So as we get closer and closer to that expiration date, it's going to come into conjunction with the actual market it trades based on. So here's an example. You see this spread was 14.80 by 15.20, and you see at the time the market was at 15.14. Now if you thought that the market was going to go up, let's say that you thought the market was going to go up to 15.20. Alright, let's say you thought the market would rally 6 points to 15.20. Well, you could buy the outright futures at 15.14. You see it had a low of the day there at 15.13, so it's right on the low of the day, but you felt like it was going to bounce. Now, if you buy it at 15.14 in the futures market, you've got to figure out where to put your stop, where you're wrong. Now here in the Nadex market, you can buy it at 15, 13, 20. Alright, so again, buy it at 15, 13, 20, which means basically you're buying it almost a full point below where it's trading. So you're giving yourself a point buffer. The reason that you're doing that is that you've still got some time to expiration, and it has a floor. The most that you can, or it has a ceiling, the most you could make on this Nadex trade is if the S&P rallied 6 points. The most you could make if you buy the futures, obviously, is infinity. It could go up forever. However, as I said earlier in the presentation, most trades don't, long trades don't go to infinity. Most short trades don't go to zero. So again, if you're looking at a trade and you say, hey, I think the S&P is could move literally 5 to 6 points at the end of the day, would you rather be long at 15.14 or 15.13.20? Well, obviously you'd rather be long at the lower price. So again, what this allows you to do is say, hey, I'll cap my reward, but that's going to give me a higher probability of success because I'm getting in at a better entry. And if you think about it, if you look at your trades and say, hey, if you could make an extra $30 or $40 or $50 on every trade just by altering your strategy. So again, even if you're wrong, let's say you're wrong on this trade and you're wrong on this trade, you'll lose money, but you're in at a point better on the Nadex trade, so you're able to bring in an extra 50 bucks even if you lose. So again, that's the type of thing that you can do with this contract. And when we talk about, kind of capping your gain sum but increasing your probability is a very powerful thing. So again, as we mentioned, if you want to open an account or become a member of the Nadex exchange, there's no cost of membership. You can open an account just to get started with as little as $100, then send Dan an email, dan.cook@nadex.com, and say, hey, I opened a Nadex account, I'd like a 12-month demo so I can practice. Put it up against the market you're trading, whether you're trading Forex, you're trading options, you're trading futures, and look at the different things that you can do. We've got a lot of different videos for you. There's a link below this recording that you can click on to get access to our trading library. We're going to have a couple of different trading contests with this, where we've got some pretty cool prizes. We've got videos on binaries, videos on spreads, videos on a strategy where basically you can use this in conjunction with the futures markets, where you can buy a futures contract and hedge with Nadex and basically be long gold or be long oil all day long and have a risk of $400 with about a 100-point range or 50-point range. So some pretty cool stuff you can do. Obviously, wanted to try to keep this to about 50 minutes to an hour to kind of give you a good dose. But I hope that you enjoyed the presentation. I hope that you'll continue to come to Trading Pub events, that you'll continue to check out a lot of the free education on marketdeal.com. And again, take a look at the trading library, the video library that we have. Basically, all you have to do is just click the link, and it'll email you access to all of our free videos that we have if you feel like this might be a type of strategy that could help your own personal trading. Thank you very much. I hope that you enjoyed it, and if there's anything we can do for you, please let us know.